Good afternoon, ladies and gentlemen. In this video, I'm going to talk about the fundamentals and the technicals of ZipPay listed on the ASX. Keep in mind, I'm not a financial advisor, so do not take this content as financial advice. I'm not recommending you to buy, sell, or do anything in particular with this stock. I'm just simply providing my own opinion based on publicly available information. So let's start with the technicals, because the technicals are real basic on this stock. We can see a nice level of support here between $1.20 to $1.30. It's now acting as resistance because we're underneath it. We went from a high of $14.50 last year down to 53 cents today. So that is horrifying. I don't think these other levels here at around 50-60 cents really make any difference, because that's when the stock was new, fresh, and it was in the growth stage, and still is really, but the fundamentals have changed since this time, so I don't think the technicals here really matter too much, except it's a technical bouncing point. So really, we don't have anything like in terms of technicals. I mean, you could just draw like trend lines here and just make up your own little TA. Some people consider this a little bit of a breakout. I do not consider that a breakout at all, because really these peaks and troughs will all act as a little bit of resistance at some point, but there's really not any clean technicals. You want something, I want something that has a bit more data to it. So really all we have is just a straight murder from $7 quite recently, and just no bounce whatsoever, just completely pummeled. There's nothing in the volumes really. It's all consistent. It's all straightforward selling stuff. And it all comes down to the fundamentals, really. So let's dive into the actual fundamentals. What I have here is the revenues in blue, we have the gross profit in black, and then the EBITDA in green. So we can see that the gross profit's been steady, the EBITDA is declining, and the revenues are going up, but what's that matter if your gross profit is flat? I mean, revenues could be $2 billion. What's it matter if your gross profit is still stagnant at 60 million, and then if you have an increasing negative EBITDA? So EBITDA is a way of looking at a company's financials. It's sort of operational profitability, I guess, is a good way of putting it. And what we have here as well is we have assets and liabilities and total equity, because you have assets minus liabilities and you end up with equity. So that's how you come to that calculation. Equity's been pretty stagnant, assets have been rising, but keep in mind there are things like goodwill that are included there. You got things like capital raising as well to get cash. So these things need to be taken into consideration as well. So we're going to dive into the investor presentation here, and we're going to take a look at what the numbers look like. So I haven't done a real deep dive into this. I've just briefly skimmed over the document, and what I'm interested in is down the bottom here, where we look at the data in detail. So we got revenue, operating income. Here we go, 303 million in the operating income, and I'll just zoom in a little bit there, which is up from the previous year, which is great. I mean, look, all the metrics for revenue are going up, but all the other metrics are kind of stagnant or in decline. So while this sounds good, and keep in mind this is a presentation, so you're going to have to skip down to page 23 of this 30-page presentation to really get an understanding of what's happening with the company, because these are the reportable numbers that ZipPay and all ASX listed companies are required to provide to the public. So these are the sort of important financial details we need to look at. Cash gross profit. So that's gross profit I was talking about. It's slightly in an incline. And then we have cash EBITDA, which I really don't typically see very often. You usually just see EBITDA or reported EBITDA here. And what we have, gross profit. So that's effectively operating income. So revenue minus COGS, or cost of goods sold, or cost of sales in this case, bit of interest, bank fees, yada yada yada. So you end up with a gross profit of 95 mil. But then you got to factor in the operating costs here, and of course you got operating costs, salaries, marketing costs, all that good stuff to actually run the business. It's not just about buying the lollipop and selling the lollipop and making a profit, but it's all about paying the staff, the wages, the rent, and all that sort of stuff as well to run that business so you can sell that lollipop, or in this case, some shitty software that other companies use anyway. We have, let's see, negative EBITDA. Again, this is the number that's kind of important. It's kind of in decline as well. If we scroll down a bit, again, EBITDA, and we can see in this case why the EBITDA is so large from last half year, and that is this 306 mil for the acquisition of QuadPay. So when we factor that outside of this last half year, take out that 306 mil, we really end up with the adjusted loss before tax here. So it's actually an increase in loss as well for ZipPay. We scroll down further, we can see the cash balance is in decline as well, because of course if you're burning cash, you're in a negative declining position, you're going to be running out of cash slowly. And the question is, where do these guys get their money from? I haven't dug that deep. I'm not sure if it's just capital raising or if they have somewhere else to get money, if they've just sought out from a bank or something like that, some sort of agreement. But what we have is the total assets here that I was talking about in that previous chart, which used assets minus liabilities to end up with equity position, which I guess is called net assets here in this document. So let's take a look real briefly. Customer receivables are on the incline, and we have intangible assets and goodwill. Not sure what intangible assets really refers to. I'm not sure if that's perhaps software or something like that. I assume it is. Goodwill is something that is included during the takeover of other businesses. I suspect QuadPay might fall into or have some aspects of goodwill as well built into this. So we have a 4 mil. And we take off a bit of goodwill. And look, I'm not a fan of manipulating the numbers for my own convenience here. We've got 4 billion in assets. It's not, one doesn't just write off 900 mil because that's the goodwill. You can't value goodwill at zero, right? It's like one of the examples I give of goodwill is if like you take over Microsoft, right? Silly example, but you take over Excel, right? Just let's say a piece of platform, Microsoft Excel, highly popular platform. It's just a spreadsheet, right? The thing itself isn't actually that special. There's a bunch of other spreadsheet softwares out there, but the goodwill comes from the fact that it's a Microsoft product. There's an aspect of goodwill there, and it values that spreadsheet significantly more than if it was another company, right? So that's what an aspect of goodwill is. So we can't just write off goodwill willy-nilly. This is, of course, just standard accounting stuff. So it's hard to just write something off. And I know some people on Twitter mention that goodwill's very high and that should be discounted. And if you discount it, you'll end up with basically a net asset position of zero. But I'm not particularly fond of just writing things off for my own convenience. It's worth noting that it's there though. So we end up with liabilities, increasing liabilities, of course, increased borrow costs. That goes in sort of direct translation with customer receivables as well. And it's worth noting that the liabilities are increasing, assets are increasing, the net assets not so much. So we've got about 1.1 billion in equity. Now, the market cap at the moment, if we go back to the chart of Zip, we were at the peak 7.6 billion in market cap roughly. We're currently sitting somewhere in the range of 350 to 400 million in market cap. Now, one thing I like to do is see how sold off a company is in relationship to its total equity position. I did this for Qantas, but Qantas, of course, is a completely different beast. It's a very reliable sort of company, and at one point it was at, I think it was at equity or cash backing. I can't remember which one it was. So buying Qantas was an absolute no-brainer. But what we have on ZipPay is we've got stagnant financials. We have revenues increasing, but we've got declining EBITDA and stagnant gross profit. So the question is, why would anyone want to be part of this business, right? The growth phase, if we look back here, so the growth phase that people were anticipating back in the BNPL boom was revenues to go up and gross profit to follow suit, and EBITDA ideally going in the green very soon after. But that just never eventuated, and what we have is a business in decline at the same time that it's growing its revenue as well, right? So one could argue that perhaps they're growing their business, maybe in the US and other places around the world. They're spending money to make money, but it's just not yet translating. So the question is, what about next half year, right? And the next half year document is probably due in a couple of months, right? So this is the last or the previous half year numbers. So the next half year numbers will be due very soon, and you guys can make a comparison there. My expectation is just EBITDA will just be even more negative. Revenues might be a little bit higher, but some more stagnation in gross profit. And, the growth phase, it's like, who wants to pay $7 billion in market cap for a company with, at the time, had about $1 billion in equity? So what was it, 7 billion, somewhere around here. So it had an equity position of 1.1 billion. It was valued at 7.7 billion, and it was pulling in negative numbers. That was the so-called growth phase, right? All the BNPLs, buy now, pay laters, were doing it. But that doesn't mean it's at a good valuation. Just because a stock's going up doesn't necessarily mean it's fairly valued or correctly valued. This thing was wildly overvalued for a very long time. Everyone could see it, but it was just a trend. It was a momentum and, positive sentiment. And, the market can remain irrational far longer than any of us can stay solvent. So, it's not like you can just short the stock somewhere around $6 and then when it pops to 14, you just, sit in the corner of your bedroom crying, going, the equity position and the negative growth. It's like, yeah, but you can't fight the market. Eventually, it comes back to reality, and what we're seeing is that reality being recognized. So, the company clearly hasn't performed anywhere near as good as Afterpay has. Can't even hold a candle to Afterpay. And ZipPay was meant to be like the second best option out there. So the market cap is tanking, but if you look at the financials that we just looked through, we have a negative growth. I don't like the word negative growth. If we have a negative position in EBITDA, a growing position in revenue, and a stagnant gross profit, it doesn't really give me confidence to say I want to buy this stock. And yes, it's got a 1.1 billion equity and it's sitting at around 400 mil market cap, which, assuming the company sells everything and goes out of business and they sell everything, they'll have about $1.1 billion worth in the company. So one could look at that and go, I'm getting 3 to 1 on my money. If I buy $1,000 now, I'm getting 3 to 1 by default. But market sentiment has crushed it. And I don't think that's a fair comparison because, look at the aspects of the total assets that I was talking about before. A good chunk's in goodwill. There's a good chunk in intangible assets and customer receivables. That's money that's due, but of course they also have a large amount of borrowings to make that happen. So, I'm not interested in these numbers. There's nothing here that excites me. There's nothing here that tells me that this stock is likely to reverse to the upside. The financials are, in my opinion, garbage. They're not healthy at all. But I say that keeping in mind that in 2 weeks' time, we're going to have a new batch of financials coming out, the new half-year numbers. And, if you're interested in ZipPay, if you're interested in some kind of investment, have a look at those same numbers. Compare them to this financial report and ask yourself, are they getting better? Is the company improving? And what are the metrics for that improvement? Whether it's EBITDA, whether it's equity, you can make up your own metrics if you want. But for me, I just look at the basics, and that is the financial reporting document that we're going through. And then I just ask myself the question, does this make sense? And no, to me, it doesn't make sense. As in, it doesn't make sense for me to invest my money in it. I don't have a position in ZipPay. I'm not long, I'm not short, and I'm not interested. I'm not interested until maybe give it another couple of financial reports, another 2-3 half-year reports, and see if the numbers improve. But I'm not going to put my money and put it at risk just because the stock is at its all-time lows, or not quite at its all-time lows, but it's been getting absolutely pummeled lately. There's nothing here that interests me in the stock. So guys, if you found this content helpful or useful at all, please do consider hitting that like or sub button. I'd appreciate that a lot. If you learned anything, please leave a comment. I'd love to hear from you guys. Otherwise, I'll catch you guys in the next video. Cheers.